It's no surprise that interest rates are higher right now than they've been in a very long time. When we look at short-term rates like the 6-month Treasury, they have not been this high since January of 2001. And at the long end of the curve, the 30-year US Treasury has not been this high since July of 2007. Interest rates on other forms of debt like mortgages are also at multi-decade highs, with mortgages reaching their highest point since 2000. But unfortunately, that pain is not stopping anytime soon. And in fact, what we will see throughout the rest of this video is there are multiple forces that are going to push interest rates up much higher throughout the entire course of 2024. And it starts with the main place the United States government is borrowing money from right now, which is currently held in the reverse repo facility at the Fed. Now, I've made multiple videos on exactly how this facility works. My most recent one was from 2 weeks ago. You can find that after this video. But essentially, this facility is an account at the Federal Reserve that currently contains a little over $1 trillion. This is money from financial institutions that wanted a place to park this cash. Currently, they're getting paid over 5% to park it there, risk-free. But over the last couple of months, the United States government is borrowing at even more attractive rates, over 5.5%. This has incentivized financial institutions who currently keep their cash in the reverse repo facility to take it out in order to loan it to the US government for a short-term loan instead. This means that the US government can borrow just about $1 trillion more at the current rates of around 5.5%. That's enough for them to attract money to come out of the reverse repo facility and be lent to them instead. But the rate at which money has started coming out of the reverse repo facility has been accelerating recently. If we look at the last 6 months, it has taken just about 6 months to drain about $1 trillion out of this facility. It was about $2.2 trillion 6 months ago, and right now it's sitting a little over $1 trillion. That would put a time period of right around March or April by the time this account is empty. But if we take a look at the recent acceleration and how fast cash has been flowing out of this account, and if that recent pace continues forward into the future, then this account could actually be drained as soon as January. When that happens, the US government will no longer have a $1 trillion slush fund to borrow from at 5.5%, which means that in order to incentivize money to come out of other places in the economy to be able to be lent to them, they will likely have to offer higher and higher rates. Because if they offer 5.5%, there's just not enough money out there anymore in order to be lent to them. So at some point, whether it's in January or as late as April in 2024, the reverse repo facility will hit zero. And a pretty immediate after effect of that will be short-term interest rates going a lot higher. And since we're talking about government borrowing, that brings us to the second thing that will push interest rates up higher in 2024, which is the debt spiral. We are currently living through the biggest sovereign debt crisis globally that anybody alive has ever lived through. Yes, other countries, especially smaller ones, have gone through sovereign debt crises, but in terms of major global powers, what is happening today is unique in recent history. One problem is that the United States government currently owes $33.6 trillion. Over the course of 2024, about $16 trillion of that is going to mature. When debt matures, that means it has to get paid back. Well, we know that the US government is not taxing enough to pay for all its expenses. They're borrowing on top of that, which means that in order to pay off this $16 trillion that is needing to get paid back over the course of 2024, they're going to have to borrow all of that as well. The problem is the majority of that debt was borrowed over the last decade when interest rates were at historic lows, and a lot of it was even borrowed near 0%. By the end of 2024, as that $16 trillion matures, gets paid off with new debt, and the government now has that new debt to replace it at the higher interest rates, we're going to see just the interest portion of the debt cost the US government somewhere around $1.2 trillion by the end of the year. This is because interest rates across the curve right now, whether it's short-term at 5.5% or long-term at 5.1%, are all in that range. If we take $16 trillion and multiply it by 5% conservatively, that puts the interest portion on half the national debt at $800 billion. If we take the rest of the $17 trillion and leave it at approximately 3%, that brings us to $510 billion. Add those two together and you get just about $1.2 trillion for the total interest expense on the national debt, and we'll be there by the end of 2024. Considering the entire national deficit for 2022 is $1.5 trillion, and that was up 61% from the prior year, $1.2 trillion is insane just for interest. This is what's known as a debt spiral, where you have to take on new debt in order to pay off the old debt, but that old debt is growing because the new debt costs so much, but you have to keep on taking out new debt to pay off that old debt. It's like a snake eating itself by its own tail. This exponentially larger increase in government borrowing pushes interest rates higher because there's more and more demand for government borrowing, so they have to pay a higher and higher interest rate to get all that cash. For the next moment, I'd like to share with you about a very important company who is sponsoring today's video, Monetary Metals. The reason why Monetary Metals is doing something so revolutionary goes all the way back to when FDR outlawed gold ownership with Executive Order 6102. What a lot of people don't know about this gold confiscation was that it also outlawed the gold clause that was very common in debt contracts, which allowed people to get their debt paid back to them in gold if they chose. Fast forward from there to 1971, when the US left the gold standard for good, there's no longer any reason to keep this law in place. But what even fewer people are aware of is that this law was actually repealed, which meant that it became legal to denominate debt contracts in gold yet again. Now, for the longest time, I was not aware that this was legal in the United States, let alone that there was any company out there actually doing it. However, when I discovered Monetary Metals, I realized this is exactly what they're doing, and nobody else is. They have created a way for you to get on your own personal gold standard by paying you a yield that is denominated in gold, it's priced in gold, and it is paid in gold. They have multiple offerings like leases that pay between 2 and 5% and bonds that have paid up to 19%. Now, just to be clear, this means that if you start off with 100 ounces of gold at 4%, then you end the year with 104 ounces of gold. The yield is denominated and paid in gold, regardless of what the price of gold does. Your gold is actually growing. Now, I have spent quite a bit of time over the last 2 years now researching how this company does what they do. I've gotten to know the team, and as a result, I've not only become a customer of the company myself, I use the products, but I've also invested into the company personally. Monetary Metals is doing something truly unique, revolutionary, by paying you a yield on your gold, priced in gold, and paid in gold. And I highly recommend and encourage you to click on the link in the description below and open up an account today. Now, the third reason that we're going to see higher interest rates outside of just government borrowing interest rates is because of the credit tightening conditions that we have right now. Banks are currently tightening their lending standards to a level that is only seen during recession time. Back in 2020, great financial crisis, the dot-com bubble burst, and 1990, tightening standards all reached above the level 50, and we are currently there again at the end of 2023. This leads us to the fourth reason that we are going to see interest rates pushed up, and that is defaults. Bankruptcies in 2023 are surging. As a result of a higher cost of servicing debt, many companies are unable to afford it. You had enough revenue to cover your debt at 1%, but now that interest rates are 4, 5, 6, 7%, you have realized you cannot bring in enough money in order to service that debt. You're bankrupt. If we compare 2023 bankruptcies to prior years, we can see that already bankruptcies have surpassed the entire year of 2022 and 2021. They're currently at the same level that we saw in 2020, but prior to that, we have to go all the way back to 2010 before we see bankruptcies higher than where we're at currently. The more bankruptcies that happen, the more credit conditions tighten, the more money is scarce because less money is being paid back, which means there's less of a multiple to make new loans from, pushing interest rates even higher. The fifth force that is continuing into 2024 that will be pushing interest rates higher is forced sales of debt. China is currently selling more US treasuries than it has in the last 4 years. They're doing this in order to prop up their currency. This is one of the side effects that the Fed fighting inflation has around the rest of the world, is that it is destroying bondholders. And then you are seeing major bondholders like China turning into a forced seller in order to prop up its currency to deal with its own economic problems. But when debt all gets sold, that means there's more selling pressure, which means that the price goes down, and the relationship between bond prices and interest rates is inversely correlated. And the more players like China sell, the worse the prices are and the value is of all existing treasuries, which means that other players may be forced to sell as a result of that. Now, all that wouldn't be really any problem, except for the fact that the biggest seller of US government treasuries is the US government itself. itself through its massive deficits, this last year running $1.5 trillion, which was 61% higher than it was the year before. These deficits have many adverse effects on the economy, but one of them is propping up or keeping things more expensive for all the areas that money is going towards. As a result of the inflation that we get from these massive deficits, we are seeing lenders being less and less likely to lend at lower interest rates as that inflation becomes more embedded and long-term inflation expectations start to rise. A couple years ago, lenders were happy to lend at 1 or 2% because they thought even if there is inflation, it'll be over so quickly, I'll still get a positive return on my capital by lending to you at 1 or 2%. But lenders are realizing that's no longer true. If they want to get a positive return after adjusting for inflation, they have to lend at higher and higher rates. But it's not just inflation from deficits. We're also seeing inflation expectations set in from deglobalization, from things like energy costs going up around the world as the green agenda has failed and has started turning countries like Germany back into firing up their coal plants, as it has drained the strategic petroleum reserves in the United States, forcing an easing on the sanctions against places like Venezuela in order to try and assist with the rising energy costs. Not to mention the multiple wars going on right now all around the world. These are all things that contribute to destruction of resources, which means less abundance, more scarcity of the things that people want and need, and rising costs as that malinvestment and misallocation of resources takes place. All things that push prices up and keeps those inflation expectations for the future embedded, pushing the price of interest rates even higher. And the final force that will continue to push interest rates up throughout the course of 2024 is going to be the crowding out effect. The reason why we're seeing mortgage rates increase to multi-decade highs is because a mortgage is inherently more risky than something like a treasury. When considering the options in front of you on where to lend your cash, it's a spectrum between risk and reward. On average, the more likely you are to get your principal and interest returned back to you, you're willing to accept less of an interest rate. But as the risk of not getting your principal and interest back increases, you are going to demand a higher and higher interest rate to compensate yourself for that risk. When you lend money to the US government for 30 years at 5.1%, the general perceived likelihood of getting your principal plus interest back is considered risk-free because the government has a monopoly on violence and they can always use that to get any money they need in order to pay off their creditors. However, something like a mortgage, you do not have an individual with the capacity to legally use violence in order to get the income they need to pay off the mortgage. And so the interest that is demanded on a 30-year mortgage will be higher than the interest demanded on a 30-year treasury. And all the way on the other end of the spectrum, you have something like credit cards, which are currently at around 21% because they still don't have the ability of the US government to use their monopoly on violence to go get the income that they need to pay off the debt. But credit card debt is also not collateralized like a mortgage is. So at the end of the day, the bank can always try and sell the property to collect some of what they loaned. A credit card debt has no collateral backing it. So the higher the risk is that you won't get your interest and principal back, the higher the interest rate will be. And when the risk-free rate is set around 5%, that means that any other lenders out there that carry some additional risk will have to be priced higher than that because you as a lender, given the two options of who to lend your money to, if they're paying the same, you're going to go with the least risky option. And so if the borrower who has more inherent risk wants to be able to borrow, they will have to pay a premium over that risk-free rate. And that is the crowding out effect because the higher and higher interest rate that the US government pays, the more money goes to be lent to the US government instead of the productive private economy. Now you might think, well, sucks for corporations, but they could just pay 6% or 7%. And that is true if they can afford it. But the higher interest rates go, the fewer individuals and corporations can afford to borrow. So you get a crowding out effect, and it ultimately even bleeds out to equities as well. Because imagine at the extreme, if the US government was to start paying 15 or 20% interest rates on its debt. If you could get a guaranteed 20% return for, let's say, 10 years from the US government, how much money would you leave in the stock market? Probably not much. You'd probably sell your stocks and give it to the government instead. So the more the US government pays, the higher interest rates go. It has an even more pronounced effect for everybody else. So looking ahead for the next year and longer, it looks like higher interest rates for everybody, it doesn't look like that's slowing down or reversing anytime soon. And if you don't know exactly how to play a rising interest rate environment, and you hear idiot financial advisors telling you to add something like TLT to your portfolio so that you can take advantage, then you're probably going to find it very difficult to make money investing throughout 2024. These things and much, much more are what I teach members of Heresy Financial University, and we are doing our very first private live stream on November 1st. We're gonna be talking strategies, tactics, answering questions from the courses, and much, much more. And I'd love to see you there. Link is in the description below. As always, thanks so much for watching. Have a great day.